Alright, I'm done with this. Now I want to tell you why I'm sick of investing in individual stocks and why from now on, except in some extraordinary circumstances, I'm only going to invest in ETFs. In the past few years, I invested a lot in stocks, and in particular in tech stocks, because they were growing great, and of course, our human psychology makes us do exactly the opposite of what robots like Warren Buffett do. Something is going great, you buy more. Something is going bad, you sell it. And my journey with stock picking went quite well until the end of last year, when all the tech stocks decided to die. Slowly, a terrible death. And since, of course, I'm the kind of person that does not practice what he preaches, I knew from the beginning that ETFs are the best investment in the long term, but I kept putting most of my money in single stocks. Well, this ends now. I want to tell you all the reasons why ETFs are the best choice for you, for me, and almost for everybody. So if you want to get into finance and you're not a Wall Street expert, chances are you are much better off with ETFs. My name is Rick, and if you're interested in finance and in learning from my mistakes and from the little things that I know, well then this channel is the right one for you. But now let's cut to the chase. In this video we're going to discuss all the advantages of the ETFs, and we're going to see why in the end ETFs are the best option for you. Be sure to stick to the end of the video because we're also going to go through a couple of strategies that are going to help you reduce even more any risk associated with investing. Are you ready? Let's go! First and foremost, an ETF or exchange-traded fund is nothing more than a basket of assets or securities, like company stocks, crypto, precious metals, real estate, and many others. To make it simple, let's focus on company stocks. An ETF is a package that contains stocks of several different companies, and when you buy it, you're basically getting a part of all these companies without having to buy the individual company stocks separately. So for example, if you like the technology sector, instead of having to buy Alphabet, Amazon, Apple, Microsoft, you can just buy an ETF of the technology sector, and with much less money, you get a slice of hundreds of tech companies. There are ETFs that cover a single industry or sector, like technology, industrial, health, consumer discretionary. Some ETFs focus on only US offerings, while others have a global outlook or focus on emerging markets. There are ETFs of literally everything. Now, the advantage number one is that ETFs lower your risk by diversifying your investment. Since the ETF is diversified because it contains many companies, even if some company stocks lose value, the ETF follows the average growth of all the companies together. This means that compared to a single stock that could hugely drop in value if something happens within the company, an ETF basically amortizes the loss of some companies with the gains of others. With one simple trade of an ETF, you get instant diversification. Advantage number two is ETFs match indexes performance. You can never be 100% sure that your investments are going to bring you profit, but let's see how ETFs do compared to the two extremes: individual stocks and actively managed mutual funds. Individual stocks are highly risky, we know that. You buy a stock, and if you didn't do your due diligence, it can go down a lot or you can even lose everything. On the other side of the table, you have actively managed mutual funds. Investment funds made out of many stocks that are actively managed by a financial expert of a bank. And here the problem lies in the task that this financial expert has. His task is to try to outperform the market. So imagine a common human being, which is an average Wall Street guy or a banker and not Warren Buffett, who wants to try to outperform the market. Good luck with that. I can tell you for sure that most of the time they underperform the market. And here come ETFs to the rescue. ETFs don't try to outperform the market. Instead, they just replicate it. ETFs track indexes. You're never going to have big surprises because a good ETF always follows the progress of the underlying market index that it invests in. Advantage number three is ETFs make accessing markets easy. There is usually an ETF for whatever you're looking to invest in, from a country in Asia to a commodity like gold to a sector like pharmaceuticals, whatever you want. So now let's say hypothetically that you've just heard Elon Musk saying that he thinks that the Chinese economy is going to surpass the United States by at least twofold. Anyone invest in that?
The thing that will feel pretty strange is that the Chinese economy is going to be probably at least twice as big as the US economy. Maybe 3 times, but at least twice.
Well, if you'd like to invest in some difficult to access markets or even some emerging markets, it would be hard to do it by entering particular exchanges and buying the individual stocks. But now you can find a lot of ETFs that are based on those markets, and they already did the work for you. So you just buy the ETF and poof, you're suddenly automatically an owner of shares of hundreds of Chinese companies. Advantage number 4, ETFs are transparent, so you know what you're getting. For every existing ETF, you can find detailed information online on all the companies included, all their percentages, and all the returns of the past. In the case of actively managed funds, the portfolio manager can choose not to reveal the investments of his portfolio. So you're basically giving him the money and trusting him to do the right thing. No, but really. And even if they decide to reveal the investments, being their funds actively managed, they can still decide to drop some stocks and buy new ones. So in the end, you're never gonna know from the beginning what you're getting into. Instead, let's say that you like technology and you'd like to invest in a Vanguard Information Technology ETF. First, you go on the Vanguard website. You search for the Information Technology ETF. From this page, you get all the information you can possibly need about the ETF. Asset class, category, expense ratio. By the way, the expense ratio is extremely important, and it's the yearly fee that you are charged for possessing the ETF. A couple of weeks ago, I made a video about the best growth ETFs that you can buy in 2022, and in the end of the video, I made an example with actual numbers to explain what is the impact that the exchange ratio is going to have on your investment in the long term. So if you want, you can check it out later. I'll write the link in the description below, and I'll also link it here. Anyway, you can also see an overview with the main info about the ETF, the yearly returns, but the interesting part comes next because you have a graph of the performance of the last few years. Look at that. Of course, this year there has been a huge drop, which by the way should be an incentive to buy. But look at the average growth of the last 5 and 10 years. These are just incredible numbers, and you're not gonna get these numbers in the long term by picking stocks. Maybe some companies, maybe some years, but in the long term, But anyway, what I wanted to show you is that if you scroll down, you can get to the portfolio composition. And this is pretty interesting because you see all the fundamentals of this ETF. And going more down, you also find the sector composition, like application software, communication equipment, and so on, with the percentage weight. And even more interested, you find the list of all the companies that you're going to get if you buy the ETF, and their percentages weight on the fund. So ETFs are transparent, and you know exactly what you get by buying them. Advantage number 5 is that ETFs are as easy to trade as stocks because they are bought and sold in an exchange like stocks. So it's not like going to the bank, talking to a guy that you don't even know how good he is, and signing a bunch of documents to have him take your money. With ETFs, you can simply buy or sell your ETFs via your broker app at any time when the market is open within a matter of seconds. Number 6, ETFs are cheaper to hold. Again, actively managed mutual funds have higher management and operative expenses, so you get a fee which is usually a couple of percentage points per year. Instead, the annual management fee of an ETF, which is the expense ratio that I mentioned before, usually ranges from 0.07% to 0.7%, which is nothing in comparison. And if you think that paying 2-3% per year on a mutual fund is not so much, then think again. Let's say that you invest $10,000 in a Vanguard ETF that gives you a 9% return per year and only has an expense ratio of 0.07%. And then you invest another $10,000 in a mutual fund that asks you for 3% per year and still gives you 9% returns. After 30 years, the ETF has grown to a value of $130,000, while the mutual fund just $53,000. So think about it, the fund manager asks you for just 3%, but in the end it cashes in $77,000 in 30 years and you're left with a portfolio value of $53,000. So there is no doubt that the management fee plays an important role in the long-term results of your investment, and ETFs usually offer low expense ratios. Okay, we discussed many reasons why ETFs are your best option. Better than picking stocks, and for sure even better than giving your money to a financial expert of a bank. But still, some of you may not be convinced and think that investment is a high risk, even if the risk is drastically reduced because you bought ETFs. So let me give you 2 pieces of advice that you can use to reduce furthermore the risks associated with investing. The first thing you should do when investing in an ETF is adopting the strategy called dollar cost average. What you do is you invest a defined sum of money periodically, for example every month, and you do this independently from the market development. It doesn't matter if the market is going up or down, you invest the same sum every month. It might sound inefficient, I know, but in most cases it allows you to achieve the best gains because it prevents your emotions from ruining your investment strategy. When you invest the same amount, independently of how the market is going, what happens is that mathematically your gains will follow the average growth trend of the ETF, cutting through all spikes and crashes. The second suggestion is diversifying even more. Buying ETFs instead of individual stocks is already a great way to diversify, but even better is when you buy different ETFs. If you believe that the Asian stock market is gonna boom at some point, you might think of investing all of your money in an Asian ETF. You might be right, but you might also be wrong. Spreading your investments across different sectors, geographies and asset classes is gonna smooth your big gains, but also the big crashes, allowing you to enjoy a constant long-term growth of your portfolio without big surprises. So now let me give you my final thoughts on why I believe that ETFs are the best choice for you and for me. Warren Buffett says that if you know what you're doing, you don't need to protect yourself by diversifying for no reason. But he also openly says that for most people, ETFs and index investing are the best choice because he knows that there are not so many Warren Buffetts around. And he's right. In the world of finance, actively managed mutual funds usually underperform compared to popular indexes like the S&P 500 index. This is called in jargon beating the market, and apparently almost nobody manages to. According to an analysis of the S&P SPIVA report, of which I'll report the link in the description below, 95.4% of all actively managed equity funds underperformed the respective benchmark over the last 20 years. And not only that, over 80% of large cap funds underperformed the S&P 500 index in the past 5 years. So what you have is that the majority of investment professionals, which spend their full-time job trying to beat the markets, have decades of experience and access to all the possible resources that you'll never have, usually don't beat the market. So why do individual investors like us think they can? Well, it's our human psychology and our predisposition to risk. Whenever we see a stock that grows like 120% in a year, we think we're gonna be able to find another beast like that and buy it before it grows. So it becomes hard for us to settle for an ETF like the S&P 500 Index ETF that grows with an average of 8-10% per year if we know that we can get 120% from another stock. And still, most likely, we're gonna get much higher gains in the long term if we choose the ETF over stock picking. So that's why I believe that almost everybody, and in particular individual investors like us, are much better off by buying ETFs that follow market benchmarks instead of picking individual stocks. Of course, what you do with your money is ultimately your decision. And if you have enough finances, you can also think about investing part in ETFs and part in individual stocks and see in the long term which ones perform better. So, if you agree with me, let me know by liking this video, and don't forget to subscribe to my channel if I managed to give you any value with this video. If you want me to cover any other topic, you can just write me down in the comment section below, or even if you have a critique, a feedback or whatever comment, and I'll be happy to answer that. So I wish you a great evening, thank you for visiting my channel, and I'll see you in the next video. Ciao!